Let's bring in Savita Subramanian. She is the head of U.S. equity and ESG strategy at BofA Securities. Savita, great to have you with us. I'm wondering overall what you're looking for out of earnings season. It sounds like you're preparing for a sharp cut in terms of forward estimates. We've already seen first quarter estimates come down by about 6% since the year began, which is much sharper than normal. But you're thinking that forward guidance will be cut as well.
You know, I think 2023 estimates are still a little bit too high, and we're expecting to see about another 10% downside to full year estimates. For the quarter, we've seen analysts get pretty aggressively negative heading into the quarter. So I think we could actually, see earnings meet expectations or maybe even beat them a little bit. But I think the focus this quarter is going to be on guidance on how credit conditions are affecting corporate spending. I think those are the key items that folks are listening for. But Melissa, I'm glad you pointed out that this is the best time to be a stock picker, because what we're seeing and hearing from our analysts is that within every sector, there are puts and takes. So for example, within materials, we're seeing strength in metals, but weakness in paper. Within financials, we're seeing, kind of different trends for brokers versus alternatives, for bigger banks versus small banks. So I think it's a very bifurcated market with lots of opportunities at a security level.
Is there a general sort of theme as to what underscores these puts and takes, Savita? I mean, is it, names that can provide more defense in a credit tightening environment? I mean, I'm just trying to figure out how investors can think about that.
What's the overarching theme? So I think it's all about these cross currents. So if you think about labor, the labor market is tighter for lower income or mid income versus high income, where you're seeing the bulk of layoffs. If you think about even the consumer, the high end consumer or high income consumer is getting more hit by Wall Street and Silicon Valley layoffs versus middle America, where you're still seeing very tight labor markets. So I think that it's not like you can apply some overarching recession playbook to what's happening right now. And I think that's what makes for a really interesting market environment. Our view on the index is kind of flat for the year, but within the index, there's a lot of really interesting internal dynamics. So, for example, I would say, commodities might not behave the way they typically do during a recession or a slowing growth environment, because what we're seeing is that demand for commodities is coming from onshoring, reshoring companies building plant in the U.S. We're seeing, infrastructure spend and structure spend remaining strong. I think what was most interesting to me when we were putting together our earnings preview last night is that companies, despite the fact that everybody's talking about a recession and, how everything could go wrong, companies are actually guiding up more aggressively on planned CapEx than what analysts have penciled into their numbers. So outside of tech, we're hearing very aggressive CapEx plans, which would be beneficial for a lot of the cyclical areas that nobody wants to touch right now. So I think there's a lot of really interesting themes underneath the surface of the market that don't match the typical recession, everything is awful playbook.